Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Welcome back. Happy October. Hard to believe we're in the last quarter of 24 here, but we're actually going to go back in time a bit today, talking about that weird vol spike in early August. One option printed a 500 vol in the pre-market hours that day, according to our guests, Martin Vestergaard and Michael Cameron of Carmika Partners. And we're doing it a bit different today because we recorded with them before that spike, but I thought it was a bit pointless to have guys who trade vol and skew and options and not talk about what happened there. So brought them back on for a quick talk through that spike and the hit they took. And then we'll give you the whole original pod going through their backgrounds and the strategy. Sound good? Send it. This episode is brought to you by RCM's Managed Futures Group, looking at vol traders, question about why one program or another performed this way or that during an event like early August. Give our team of specialists a call and get the inside scoop on dozens of funds and CTAs we work closely with. Visit rcmalts.com to learn more. All right, everyone, we are back with Mike and Martin from Carmika. And like we said in the intro, did a pod with them last week of July. Then right after that, we had a bit of a crazy last day of July, beginning of August in the vol markets. So before everyone hears their full story and what they're doing with the model, I thought it'd be good to bring them back on for a quick little talk. Their program took a little bit of a hit. A lot of other vol traders took a bit of a hit. So wanted to get their look at what the market was actually doing those days before you hear the full story. So welcome back, guys.
Thank you.
Thanks, Jeff. Appreciate it.
No worries. So let's dive in. I don't know who wants to take it first, but now that we've had a month plus after that crazy vol spike, what was happening there? And was it even a vol spike? There's a bit of material out there that was saying it was a bit of a head fake itself.
Yeah, I think our understanding of what it was, it was definitely a VIX event more than anything else. Obviously, the curve kind of moved around, but for instance, on Friday, vol started going up, and Skew started going up. I mean, probably don't need to explain necessarily what Skew is, but Skew obviously is puts getting more expensive relatively to calls, so people are grabbing for downside convexity. That started happening on Friday. So, I mean, what we did on Friday, we cut our risk a lot and went in with what we thought was a very tight book in terms of margin and everything coming into Monday. And then obviously Monday, I think one of the things that happened as well, which seems a lot of people don't really talk about, is the SIBO didn't really open until 2:30. So nobody could really trade. So when you look at the VIX, that pre-market was up 150%. Reality is nobody could really trade that because the option market, things were quoted. I mean, daily options were quoted really, really, really wide. And it was just basically the first 2 to 3 months of the S&P curve that went completely, utterly ballistic. I mean, from what we heard from a vol guy over here, is supposedly September, so this was obviously in August 5th, the September 2500 put in the S&P on that Monday traded at 10 ticks. That's the equivalent of 500 vol.
Mm.
I mean, I've never seen S&P above 100 vol. So
right. With the market down less than 5%, what was the market down?
Yeah, mine's probably down 4%.
Yeah, and so 500 vol.
I think one of the bigger things to really have an understanding of, obviously when something like this happens, you think, can it go and happen again? And, the old school guys would say, when it happens once, it doesn't tend to happen again. But I think one of the reasons why this, from what I understand again, it was 2 OTC call spreads that somebody had on with the banks and the VIX that obviously blew out when VIX started going up. But again, it was probably a little bit more of a head fake because things obviously blasted back out. And what also didn't seem to, the back end wasn't really reacting. And one of the things we had on back then was we were kind of short a bit in the front and long in the back. And that obviously didn't work. So the thing is to think about why can this happen again? And my basic view is, I mean, we've just seen it in the last like 2 or 3 months. I mean, we're seeing more of these erratic vol spikes where you really don't get a underlying move. And a lot of times, for instance, what we really need as we trade primarily Skew. So what we really need is we need a movement to come in the marketplace so you can have the gamma and whatnot set in. And if vol just sits and moves around erratically, obviously, if you're short vol, you're going to lose money. And if you are long vol, it's going to go up. But over time, even if you're long vol and market doesn't move, it's going to be hard for you to pay for that long vol.
Right, you'll have to have perfect timing.
Yeah, so it does feel a bit to me like the market's a bit broken. I hate to just say that just because you kind of when you lose money, but there's something very radical how I think the vol market is reacting. And my feeling is a bit, I think some of these daily options are playing in on it a lot. It doesn't feel like there's a lot of activity. And I mean, Mike, I think you have the numbers for the numbers of daily options that's traded on the CBOE on I mean the amount of gamma and delta hedging that has to accompany that would have to be amazing. I mean, the numbers would have to be big. And I think the real question that everybody should answer is, let's say the market actually, instead of being down 3 or 4%, which it was down 10% and limit down. What will be the effect of all this daily stuff, now daily options on the VIX? I mean, so the reality is one of the things as a risk scenario you just kind of got to have in place is irrational VIX spikes.
So that's actually, sorry, go ahead, Martin.
No, sorry, go ahead, Mike.
I was going to say actually with all this that went on, right? So obviously August was disappointing, and it was a VIX-led spike that we saw. We didn't see kind of the same coincident move on kind of the downside, right? So as you mentioned, the downside was pretty shallow. It was like a 4 or 5% sell-off in the S&P. So not really a massive drawdown compared to the level of VIX that we saw. I think we saw spot VIX touch 65. It never traded up there. But, given that level, you would expect the market to be down at least 10%, right? As you kind of came to it, and it wasn't. As we kind of talk to investors, it's interesting, right? Because everybody wants the profile that you are long volatility, and we were long volatility coming into this event. So it's amazing that we kind of had this performance result, even though we were long volatility. What we had on was a spread. So we had like a little bit of September, relatively small too, because we needed some carry. And we had talked about in the podcast all of that front month short vol exposure that was out there. And against that, we had longer dated optionality. Not that far out, though. I mean, I think June 2025, Martin, was kind of the furthest that we had. So we modeled up that spread and looked at the ratio over time. And it's interesting, right? Because even during COVID, 2022, our measurements and anticipations of where that spread would move was fairly contained, and we were fairly confident that we would get a nice result in a market drawdown. But this was just such a massive outlier and an abnormal event that had never taken place in the market. It was more than a 6 standard deviation event. And that was just something that was never modeled over time and couldn't have been spotted, which is unfortunate.
Well, one quick thing to clear up, Martin, you were saying CBOE not till 2:30. You're talking London time, right?
Correct. Yeah. Sorry.
Yeah. No, I was like, what? Was it closed here in Chicago until 2:30?
No, you know what? There were prices on screen, but they were 50 to 150 points wide. Some of the daily options. That's probably highly likely why that option ended up trading at such a stupid price, because somebody just had to do something and there was no real liquidity. But liquidity started coming in as soon as the floor kicked in at 2:30. I gotta subtract 6 hours. So
8:30 art.
8:30. Yeah.
Yeah, and we talked with a large firm that was trying to sell those VIX futures. They were seeing 46 or something, right? Trying to sell it. I don't think they could actually get filled till 28 or something. So even in the VIX futures, that spike was a little unreal. So
yeah, and I think the takeaway from this, obviously, when something like this happens, I've traded options for probably too many years, but I've never, I've never had a real like any significant, loss, and most things like, yeah, we've had weird things happen. 2008 was obviously weird, but it happened in a controlled way. It was a massive spike in VIX, and we saw COVID where we saw VIX spike up as well. And during COVID, we were, that particular day, I can't remember how much we were up a lot. And it was just a very different move.
yeah,
This was definitely associated with VIX, and for some reason, everything else just, it was like the correlation kind of broke down across the curve in some shape or form.
it's also like I think of it like an airplane, right? Of like it's the engine blew out and you're crash landing, right? That's everyone's panicking. It's scary as hell.
Yeah.
But versus the plane just blows up in midair and you fall to the ground, right? This was more of the latter. It just happened very fast.
We also,
and the lesson from it really is, as much as I kind of mentioned at the beginning, when something tends to happen, I remember one of the companies I used to work at, the guy always says, so stupid, we're sitting here in 2005 and stress testing our portfolio in the 1987 scenario or the 2000 scenario because they've already happened. We need to find a new scenario to test on. And that's obviously how the world works. We react to the current information, then everybody reacts to that, and then probably from positioning that it happens in some shape or form. But I think we have to really acknowledge that these markets are becoming incredibly electronically driven. I don't think. I think market makers and you have you have ETF and you have all this other flow in there. You have short vol products, you have daily options, you have options on every single thing in there, all traded. And I think majority of the trading in the futures, it would not surprise me if that's really just this delta hedging compared to people buying or want exposure to the market or want to do something else. And I think that makes it a very technical market. And I think that's also one of the reasons why we're seeing these. I think was it last week we had another where VIX was up 17% and the market was down 0.7. That's we used to at least not see those things. I can say that it started in 22 where we had several days where market was down and VIX was down.
Does it make you want to flip your whole, right? Is it better to be long the front end consistently or it's too expensive to do that? Is that what you were saying before?
You know what? You obviously have to belong it in some shape or form. So we've kind of come up with what we think is quite a good way, because I think right now, for instance, to talk a little bit current about the market, Skew is very, very high. According to our own model, we are seeing Skew touch up to the level we last time saw in 21, and 21 was an outlier we haven't seen in a very long time. And I also think that's part of the reasons why we get a market that's really been sitting in a 50, 60 kind of point range. Market goes down 1%, goes up 1%, kind of sits there, but you got VIX at 22. That obviously means the market can move, 1.3, 1.4% a day. And in theory, people should be okay if you're short the gamma, but there's obviously a bid to the vol, and it seems to be coming primarily through the Skew.
So you've been doing this, you said almost too long. Two things I think of there. One, is it maybe just it's permanently break even, right? Overall, any option strategy. We used to say that all was about short option sellers, like, oh, they'll make money for 5 years, but then they'll lose it all back. Right. Yeah. Like it almost makes me think, is any option strategy terminally break even and you can do well for a while until some dimension hits you? Like, what are your thoughts on that?
No, I think, obviously, I think strategies all work for a bit and then they don't. And I think a very good trade example of that is the dispersion correlation trade. It can work really well for a long time. And then all of a sudden it just does not, it will not compute. But then obviously that means there's a time to it, because I think it's different. Options are obviously very different than a stock. If you buy a stock, and we've all had these trading accounts where you own a stock forever, because that's where it goes, because you got wrong on it. But with options, I mean, it has to be some kind of quantitative measure on the realm of it, because they obviously have an expiration date. And I mean, so I think like right now, for instance, it's a bit tough right now because Skew is so high, but Skew can't stay up here unless we get a move. So the thing is with options is it can stay obviously high for a while. And so, but when we're looking at like right now, for instance, vol looks low, like looks okay to us, but Skew is what's expensive. So you really want to run a book now where you're long vol and short Skew. And on that top, try and be long gamma if we break out of the ranges. Because right now it seems like we got this range trading. But to go back to your questions, no, I think I think it's the same thing with stocks. I mean, everything goes in and out of fashion. I think we just all anybody that really trades option now really just have to be aware of the impact, I think, of this dailiness of options that's coming in, because I do think it's affecting the market in some shape or form.
And then, Mike, maybe weigh in here. How's something like this weigh on the psyche of a manager, of a CTA, of a hedge fund, right? Of like, how do you keep your mental abilities and say, hey, it was just a blip, right? How do you keep confidence in yourself and in the model?
I think you have to kind of analyze the event, right, and figure out what went on. I mean, the reality is like even the best trading models are going to be subject to kind of a loss at some point, right? So the essence of a good manager is how they kind of come back from that, learn from that, put different risk measures in place to kind of circumvent that from happening once again. And you know, I think the model over time, I mean, you know, we've got a lengthy track record, right, which can't just be thrown out the window over 1 month performance. So, you know, I think it takes time to kind of when you do experience a loss, you know, I think people tend to back away and kind of are very short dated in terms of their thought process and thinking. But that just comes back over time, right? Showing kind of what you can do, how the product performs, et cetera. Because the reality is we got a great model when it comes to looking at, you know, the overpricing and underpricing of these out of the money options, right? Which is what we look at, the skew. And it's a unique model that really looks at the S&P 500, the most liquid index in the world, right, for index options. And we get a lot of intel just in terms of the way investors are kind of positioned, thinking about the market, et cetera, from, you know, the proprietary measures that we have on our side.
You think it's possible that skew can't be right? Is it properly priced? Like the market's saying what its price should be, right? So your models are saying it's highly priced, or that it's high, quote unquote high. But right, if the market's saying no, this is where it should be given, right? There's a question in here somewhere. I'll get to it, but say the market is putting in those 0 DTE and all these other factors, and that's why the skew is priced there, right? And so it's not actually high; it's just where it should be given all these other factors.
That's a valid point. But obviously the thing is when you see the, you know, when the VIX kind of moves on a day-to-day basis, the VIX is essentially you gliding up and down the vol, you know, the vol curve. So if you go down, you glide up that curve. At the same time, put options that are sitting further down has to glide down that curve. So, you know, when skew tends to get too high, it's just that at the money vol can't go up by that amount. So that there does become a mathematical, you know,
certainty to it. Yeah.
But I think the reality, as you just said, if people gotten burned on this, and you know, obviously also now you got the Middle East, you got an election, there's a lot of events going on. Things can stay out of whack for longer, you know, than you think. But options do, on the other hand, have to expire. And obviously the thing is you can essentially construct trades now where you short skew, long vol, and long gamma, and you pay very little for that gamma. So you're basically getting that gamma not for free, but you pay much reduced cost for it because that skew is so high. And that's how we're basically constructing the trades now. Whereas the trades before were more like pure skew bets. So now they're basically assessed with long vol and and convexity against it.
So do you think a lot of zero DTE traders lost money that day, or you think it was just one OTC that had to blow out?
I mean, obviously, if you were, down at the local pub or on vacation, and you came back a few days later, I mean, you all were good.
Yeah.
But the mark to market on that day would have been horrible.
Yeah, that's always the frustrating part. The responsible people analyzing it took the hit.
Yeah.
What's interesting is just the liquidity of the zero DTs, right? I got from the SIBO just the daily volumes that had taken place. And I mean, on that Friday and Monday, they dropped down dramatically. So, people always talked about the open interest and how, not the open interest, but just the daily volume in terms of percentage of total volume of S&P 500 options. And that was always 50% or higher, right? Zero DTE options. I think on August 5th, that Monday, it was less than 26%. So liquidity dried up.
Yeah, which always makes me think, it feels like there's a period between that August 5th where there are a bunch of traders sitting there like, oh, if it snaps back, we're all good. And then if it, as you said, Martin, if it goes another 5%, like some of these other trades would have started to kick in. The long end would have started to rise, right? So it seems like there's like
exactly.
a buffer period.
We were holding outright puts too that were further down, short dated. They just didn't get a chance to kick in.
Right. So I'd wonder if the part of the casino of the zero TTE, they're like building in or waiting for that buffer. Right. That's the risk they're taking on of like, let's not panic. If it's pre-market, if it's such and such, just let it play out. But to me,
imagine individuals traders that sit at home in their underwear probably did okay because they're probably less like, ooh, I hope this thing, and then they were right. And they got bailed out by the dip. Whereas the guy who probably sat and had a risk manager by his desk 2 minutes after this thing had to close it out.
Yeah. Which is just bad lessons, right? That'll mean next time you'll buy the dip again, and if it legs a second time, that's when the real trouble will start.
Yeah, I think that's this thing with this market here. I mean, it has obviously been a buy the dip, and it has been the right strategy for sure. I mean, it seems to be defying, gravity, but that's why we have a market here that's very close to an all-time high, and at the same time, you're not having VIX anywhere near the lows. I mean, it's sitting well in the middle of the range, and that should probably tell us something of what's going on.
I do all I could do not to sing the Wicked play, Defying Gravity there. Yeah. They're coming out with
us, why not? You have the microphone.
Yeah, the movie's coming out, right? It looks good. Well, thank you guys for coming back on. I think we'll leave it there. Give us some color, and then for everyone, you can go now listen to the full pod where they talk about the strategy in more detail. Okay, that was the new recording we just did, talking about early August and the vol spike. Now we'll go back in time and give you original pod with Carmika talking through their bios and the strategy. Send it. Again. All right, everyone. We're here with Martin Vestergaard and Michael Cameron from Carmika Partners. How are you guys?
Good. How are you?
Good. And Martin is in London. That's correct?
Yeah, that's correct. Yeah.
And Michael is traveling. You're usually in London, Mike, but now you're in Toronto?
I'm in between the two. I also spend time in Spain. But yeah, that's correct. I'm in Toronto.
What part of Spain?
Palma. It's in Mallorca.
Oh, that's right. That's right. Sounds exotic.
That's nice.
Let's do it one time.
Can't complain.
That's the island where they're kicking out the tourists now.
Yes.
I got it. And then I'm a bit of a Tour de France nerd. We just came off the Tour de France, but Vestergaard or Vestergaard, right?
No, Vestergaard. Oh, so you're looking at the Danish guy that won it a few times in a row, I guess.
Jonas
I unfortunately know nothing about it besides I know that there was a Danish guy that won last year. I don't even know if he's on track to winning this year.
He got a spoiler alert for anyone who hasn't watched the replays yet, but he got second this year.
Oh, he did?
Yeah. After he got in a big hurt. But that's a big thing. They're always like,
he had a big accident in February or March, didn't he? So people thought like he shouldn't really even be broke like ribs and whatnot, I think.
Yeah, I think major breakage. But back at it. All right. So people didn't. If you came here to listen about the Tour de France, stay on. We're gonna get into all the good stuff these guys are doing. But Martin, why don't you start out a little personal background, where you got from, how you got here.
Okay. I studied in Denmark and had a year abroad in 95, 96, ended up going to US to study for a bit. And there I was taking a finance class about options, went back to Denmark, finished out my degree in basically financial engineering. And when I was done in 98, I decided to go to Chicago and try and get a job there. And I interviewed with a few companies and started out with a company which I don't think actually doesn't exist now, Arbitrate. It got bought by Knight in, I think, 99.
I think Knight doesn't exist either.
No, I think Knight was the one that had the trig blip.
Yeah, whoops.
Yeah, where the first flash crash we had, where they went kabooey on that one. But I then started on the floor working for a DPM. So for people that don't know that, Designated Primary Market Maker. So we were responsible for 16 or 17 symbols. And my job there was to run the ball curves and work with the traders in terms of managing the risk. I mean, the biggest symbols we had back then was Nortel Network, which probably doesn't exist now again, one of the Canadian stocks, and then Broadcom and Charles Schwab. And obviously awesome. Broadcom is, now beast. But I was there for about 10 months and I realized the floor is just not me. You stood around 90% of the times, and 10% of the times, obviously you were super busy. And I mean, without saying too much, I think in the pit we were in, that we were running, if 80% of the people had an alcohol problem, I'm probably estimating that relatively low. But it was a fun 10 months. I then left them and started at Hall Trading. And I decided I wanted to go a little bit more into the engineering side. Long story short, Hall Trading went to London, because obviously at that time, this was 2001, there was a big electronic push in Europe, and Hall was obviously one of the pioneers in electronic trading, and actually had a fantastic system compared to what I came from at Arbitrate. So in London, that was the role, trying to help them build that out, and we were market makers over there on all the European indices, and left them in when was that, 2002, work for a hedge fund called Horizon Asset Limited. They were primarily trading credit and what are they called? Asset swaps. So essentially, asset swaps are call options on options on credit. So you build up like you do, so we valued those and figured out that they offered a lot of value. So instead of being long the CDS, say at 1,000 points over, you could be long it at 750 points over. So what you did, so Horizon Asset was primarily a converts art fund. So what you do is you get the convert, but you get rid of the credit element, and you just kind of own the equity asset element, but you have the credit element in terms of a call option. So that was interesting, and I was building out an option business there as well. I then left them in 2004 or 5, can't really remember. Went to another hedge fund called Horizon Asset Limited, where no, not the Centaurus Capital, sorry.
Yeah.
Where my job was to be essentially a risk manager, but we ended up trading a lot of option skew, because Centaurus Capital was an event-driven fund, so their primary risk was, a deal breaks and it goes kabooey. So it was very natural to use options to kind of hedge that, so you can get that, asymptotic payout. But obviously, you can't just sit and buy options, because then you're going to go broke. So we had to come up with certain ways of doing that. And back then, similar to kind of what we do now, we traded a lot of convexity in indices to kind of hedge the book. And then I left them to go and work with the third partner in our business, which is Manjeet Modan, at a company that he had helped found called ADG. And there we were basically just prop trading whatever we could in options. I mean, with primary focus on interest rates. So a euro dollar, short sterling, Euribor, all that stuff. Bit of commodities through the ETFs, so gold and oil, and then obviously S&P and Euro stocks and CAC and DAX and whatnot. But the thing is, you started finding out at this point in time was liquidity in Europe, besides basically the Euro stocks index, it's not great. I mean, it's nothing like what you see in the US. I mean, looking at the S&P. And then I left that, I think, in 2012. And I think Mike and I kind of got in touch in 2015. And he had like an idea because he had a family office that he knew out in California. Yeah, and then I think 2017, I mean, I'm not good with the dates. I think we kind of started Carmika Partners, and then, yeah, that's it.
Love it. And I've always been calling it Carmika. Carmika?
You know what, to be honest with you, it's a little bit of a weird story because we originally were called like another name, Convexity Capital or Partners. And then we figured out that somebody else had already taken that name, so that didn't really work. So the point is, we were sitting overnight, Manjeet and I was like, okay, we got to find another name. And Manjeet was like, let's look in Sanskrit, because anytime you want to find something that involves like convexity and partners, like all the names are taken.
Yes, yeah, all the Greek names.
We went into Sanskrit and figured out that Carmika or Carmika, depending, I'm not a Sanskrit expert, actually means shield bearer. So there you go. And nobody had that name.
Some of the protective nature of what we do comes out in that name, obviously.
I'll stick with Carmika then. It sounds like I'm not totally off.
Might be interesting because India is obviously seeing massive growth, so maybe it'd be a household name over there.
Right.
I know.
A few questions I'll come back to, but Mike, let's go with you and
Sure.
Kind of your background and then into the firm's background as well, if you could.
Yeah. Okay. So in my career, I started off in the 90s. I started off my career in equity derivatives sales trading. I worked for the bulge bracket banks, so Soc Gen, Deutsche Bank. My last stint on the bulge bracket side was at BAML. And really what I focused on was covering both pension plans and volatility arbitrage accounts. So providing them with trading ideas. Typically, a lot of the relative value volatility managers were trading at the time index spreads. So looking for cheap value in Europe and Asia and spreading that against the US market. Also, dispersion at the time was quite big. So taking advantage of, the implied correlation levels. So it was great. I mean, I had a different range of clients. I got to see a lot of different flows. And it's interesting because, after the financial crisis, a lot of those types of trades broke down. And I think the trading styles really adapted and changed. After that, I moved on to the ETF side where I covered alternatives. So I headed up it was a European-based manager. I was based out of New York. And essentially, I was speaking to a lot of family offices, RIAs, and really giving them investment solutions for some of the problematics that they were trying to address. So I spent 4 years of that. I'd met Martin and Manjeet during my equity derivative sales and trading days. And we came into contact with a family office that I knew, which I guess is a segue to how the firm was developed. And essentially, they were looking for an investment solution. So they had invested in tail risk funds in the past. And those hadn't really worked out. This is 2015 that we started talking about the idea. The actual trading and product that we're trading today came to fruition in 2017, but the discussions started in 2015. So they'd invested in tail risk funds. They had this kind of like perpetual bleed to it. And then they were looking at volatility managers, and volatility managers, when you get into kind of the space, there's a lot of complexities. So, it comes down to trust. And really what they wanted was a liquid solution to giving them, capital and a market drawdown so that they could take advantage of dislocated assets. So they had private equity, private credit in the portfolio, beta, and real estate, right? Which is a lot of the holdings that we see today with a lot of asset allocators. So they wanted something that was going to have minimal bleed, if not positive return, but do well during a market drawdown. So I introduced them to Martin and Manjeet, and that's kind of how things got rolling from there.
I love it. It's just popped in my head that your job would be infinitely easier these days. You'd just be like, yeah, everyone's selling volatility. Just get in there and do it. Your old job, right? Of selling option strategies.
Yeah,
So,
exactly. I mean, when you're kind of sitting on the sales and trading side, the job is to kind of generate flow. And obviously, the short vol trade people have been piling into that. But history repeats itself, right? So
exactly. It rhymes. It doesn't repeat itself. As the old saying goes. And then Martin, two questions I jotted down when you were giving that back. One, where was the U.S. school?
That was actually it was because at my dorm in Denmark, there's a guy coming over, and it was a little bit weird. He was Northern Illinois University. I was only there for like a year, and actually took some accounting classes and realized accounting is the most boring thing ever on the planet. But they had an options and futures class, which I ended up taking, which was actually quite interesting.
Right, fortuitous. So I was gonna guess it was there, or Idaho has a place, or right. It's got to be some
No,
like
this is
Chicago.
actually in DeKalb, Illinois, and I remember the winter there. I got there. I mean, I've never experienced anything in the vicinity of being that cold. I mean,
this is a Scandinavian
I
talking
bought my
too.
winter clothes from Denmark, and it was just utterly useless.
Yeah, out in the plains out there.
Yeah, because what happened is supposedly when the corn gets chopped down, the wind, it was obscene. I mean, people were putting stuff in the gas tank because otherwise the gas tanks were freezing up, and I mean, it was just crazy.
And one question before we get into the strategy, both of you have kind of been in and around all these different types of options, right? Not just stock index options. So talk for a minute about, is an option just an option at the end of the day? And once you understand the dynamics of each market, you can trade that market? Or do you see massive differences in index versus non-index options? And then, as you said, US versus European index options.
I think that liquidity wise, I mean, I think the US, is obviously fantastic. I mean, the S&P index and the E-minis, I think the liquidity there is great. I think there's a difference whether you're trading index, which I kind of consider systematic risk, or you're trading individual names, which is idiosyncratic. So obviously, when you're at a bank and you are sitting on a desk, a lot of the flow comes in individual names. And a lot of times the flow, you got to kind of assume, all trading at this point in time, we're sitting on the floor of Goldman Sachs. So you got to assume somehow it's quite informed flow. And in an index, without assuming too much, the index is not going to go to zero. Whereas an individual stock obviously very easily can go to zero or be taken out. So in an individual name, you just, from sitting in that seat, you're a lot more concerned about your tails than you will be in an index. So I think that's obviously the difference with it. But I think it's very important to understand whether so at Centaurus, we also looked at credit options. So they were all OTC. And we looked at FX options. And, so FX option market is super liquid. So it's an enormous size. I mean, just fantastic size. And vol, was much lower than, I haven't looked at it for a few years, but it was much lower than index vol. So it's like in 7 and 8. I don't know if you guys remember, but the yen and the Swiss franc, every time the market puked, the yen would just rally, and everybody's
flight to safety.
They're freaking bankrupt, and it was the unwind of that carry trade. And we were, at Centaurus, and we were like, S&P vol at this point in time was 20, but you could buy the yen vol for around 9 when we started doing it, dollar yen vol. So you could go and buy call options or call spreads at like half the vol. And the craziest thing we actually saw back then was Swiss euro. I think the first clip we bought, we paid under 4 vol for euro Swiss. But you looked at euro Swiss correlation with Euro Stoxx index was 98 to 99% in 2007, 2008. I mean, it was just crazy.
Yeah, wow.
And it tells you that people were just borrowing money in Swiss franc and buying Euro Stoxx. And obviously, when the thing blew up, and I remember we had a day where the yen rallied 15% against the sterling.
Ooh.
Yeah, I mean, it was brutal. So we made a lot of money having that unwind of that carry trade on, because that really was how you were, in my mind, were hedging a book back then, because it was very interesting. Without going into too much detail, we can go into that later. But going into 2007 and 8, like 2008, well, everything blew up towards in the second half. Convexity was it was very low. There was no demand for put options. None.
Before
Absolutely
it blew
none.
up or after it blew up?
Before it blew up. And
Yeah,
even in like a few days into the blow up, no demand. I mean, because back then everybody was like, private equity is going to buy this, going to buy that, blah, blah, blah. And that's what they did. So everybody was just coming after the calls. But then it was like a 2-day window and the whole thing shifted. And I mean, you got an enormous move up in Skew, and it seemed like the market was awash in like short gamma and short vol.
that was needing to be covered super quick. And then you're also, when you were on the floor, CBOE, you were the guy who basically designed, everyone had their sheets in their pockets, right? With
Yeah, I
all
mean,
their
I did.
vol
I did wear
levels
the
and
the
matching
the,
it
the
up.
jacket. Yeah, I
You
do
still have
remember.
the
I mean,
jacket?
standing up every day was hard. I mean, it was incredible. I mean, it's a fun place. I'm happy I tried it for the 10 months or 11 months or whatever it was, but it was not for me.
Love it.
So you kind of touched upon an important point. I think you'd asked, is an index option, the same as any other option, something to that effect, correct?
Yeah, and you're in your background of doing a lot of different option things. Yeah.
So I think as it pertains to what we do, I mean, that's an important distinction between us and others in the marketplace. So one of the things that's most important to us is obviously liquidity, right? So we're only trading index exchange traded options. I mean, having lived through kind of like the financial crisis of 2008 and watched a lot of the OTC unwinds with a lot of hedge funds and kind of the return stream that people were kind of producing up till that point, I think given the fact that, both Martin and Manjeet are market makers by design, liquidity means everything. So that's number one. We only trade exchange traded. I think the other important point and distinction to what we do versus others kind of in the relative value hedge fund space is that, we're trading the most liquid index options in the world, but we're not actually introducing other indices into what we do. So we only trade WIN index. So the relative value aspect to what we do comes in terms of spreading that against different strikes. But the reason why we actually only trade the S&P 500 is during kind of market drawdowns and market sell-offs, we aim to produce positive returns and provide this defensive mechanism within the portfolio. And by not introducing other products into the marketplace, we cut down on that basis and correlation risk,
Love
which
it.
I think is an important distinction.
And the issue is you're giving up those quote unquote obvious trades like in the Euro stocks versus Euro yen and things like that, where you see this cheap volatility.
Yeah,
I mean, I
because
think the problem with the FX options, I mean, I haven't followed it for a long time, but back then it was solely OTC.
So you had
I don't
credit
know if
party
there's
risk.
stuff listed. I mean, it probably is the same thing today. I'm sure there's something listed there, but the size you could do back then was just it was wild. I mean, it was a fantastic market to trade. And Vol, and the thing with it was very. You look at Eurostox and S&P. So Eurostox feels like it's vol guys. Europe doesn't have. I think if you walk around the street in Europe and you ask like a random guy on the street and says, "Do you know the Eurostox 50 index?" and people look at you like, "Huh?"
What?
You know, a lot of people might not even know the S&P index, but they definitely won't necessarily know that. But it's a product where a lot of vol guys are in playing it, so it's very efficient. And it is liquid. I mean, you can do a lot of size in it, but it's just we don't see the same opportunities you see in the US. I think the US, the fantastic thing with the S&P is you got the VIX, you got triple long, triple short ETFs, you got these massive stocks like Apple and Vita that's just going up and up and up, and you got people around the world doing something needs to dump or buy a boatload of Vega, they go to S&P. I mean, so you have all these actors in there. You got daily options. You got, there's so much rope for so many people to hang themselves so many times over. And I think that causes these trading opportunities that we just see so many more of in the S&P index than the Eurostox index.
Love it. I bet 40%, 4 out of 10 might say they know the S&P in the US if you're walking down the street.
That's probably, yeah. I mean, to be honest with you, I mean, without saying anything, I've in this term here with Carmika or Carmika, however we're going to pronounce it, I have met one or two people who didn't really know it. So I think the Eurostox 50 is just, I mean, nobody knows that one.
I think the big thing that people kind of underestimate on the S&P, just in terms of our conversations, is just how much liquidity is in that marketplace, right? So, I mean, I don't have the exact figures from SIBO, but it's somewhere in the realm of over 1.2 trillion notional a day. So it's a very deep liquid market.
Larger than the underlying? Do I read that right, or just that the volume's larger than the underlying? The nominal volume, I believe.
The nominal volume, correct.
Yeah.
I also think, I mean, the key reason why you're probably seeing that liquidity is because you got these individual stocks like, whatever the Magnificent Seven or whatever we call them. I mean, underlying liquidity just in individual stocks in the US is fantastic.
Yeah.
I mean, you can go on the screen and, so I remember just as a little tidbit when I was on the SIBO, that's when these exchanges were opening elsewhere. And these locals were obviously used to either turn themselves on RACE, which stands for Retail Automated Executing System, and then go down to the Billy Goat Tavern and sit down there and just trade on the bid and offer and don't even have to do any delta hedging, which was obviously nice because the spreads were so wide. And then, when a broker would come in, you basically give him the screen market and maybe you have to prove 10 cents. But in that just 10 months I was there, a broker would come in and he would have 3 or 4 exchanges in his headset.
Mm.
And a lot of times, in the beginning, the locals in the pit will be like, we don't want to participate in that. But then you realize, then it's just trading elsewhere. So spreads were definitely starting to come in. I mean, and I remember moving to Europe, we were trading Nokia. I mean, I think we were trading 2 cents wide market in enormous size. So I think this liquidity that's definitely coming to the marketplace, I mean, it's great for the end user. Whether that's high frequency or what it is, don't know, but I think I think the end user is the winner in this game compared to in Europe, because in Europe, I mean, I think, again, I might be overstepping a bit, but in Eurostox 50, I mean, you might have real liquidity on the 10, maybe the 7 biggest name in that index. Nothing like in the US.
On the options or overall?
Yeah, options, yeah. Stocks probably okay, but they're okay. But on the options, I mean, single name liquidity in Europe was probably a handful.
Yeah.
Even back then.
So we've started to touch on it a little bit, but let's dive into the main strategy, the main thing you guys are trying to do. You've mentioned kind of be there in a market crisis, but how do you get from all this liquidity, trading S&P to that endpoint?
But what we basically do, we have a quant model that's been developed over X amount of years where we try and model the option prices, or we aim to model the option prices. And I mean, this model, we actually used that back in the days, so this is a slight modification of that. So it's probably been around for about 15 years. And what we can do is we can model, essentially, we can price options, call options and put options across the curve. And given the fact that volatility is very much a mean reverting element. So a lot of people will look and say, okay, vol's 16 and market's moving 20, so think that it's cheap in terms of implied. We don't necessarily care so much about that, because it's more for us to sit here and say, is the market overvalued? Is vol cheap or expensive? I mean, we know whether it's low or whether it's high, but we're not the type of people that's going to go in and buy a lot of vol. We tend to play a lot more in the wings of the options, of the curves. And, and that's where our strength come in, is without getting too technical, but we can use a term like skew, smile. Yeah. So smile is obviously the, how rich our put options versus call options would be the simple way of looking at it. And one of our things come in terms of modeling that. So pretty much I would say 80 to 85% of our trades are happening in the put wing in the 10 to 30 delta. So pretty far out of a decent amount out of the money, because that's the element we tend to see that reacts. It's the element you can own that. Obviously, you want to own skew if vol is low and skew is low. But the problem, I think, that the reason why we can do what we're doing is because in the option market, I think a lot of people, when they go in, they look at the option price and they just see this is the price I'm going to pay for that. And they might look at that and say, well, they're going to sell that, and they can look at that premium they get and they can annualize it. And that's how they value the trade. We obviously don't necessarily care what the option cost, but we care about the underlying implied volatility. And when we compare that implied volatility to historical data, like going back, say, 10, 15 years, and the same thing with the smile, and we think that's too high, that's too low. So that's where our edge comes in. And going into 22, and even, in COVID, which was a very interesting, COVID was probably the truest black swan we have had in many
87
years.
probably.
Yeah, 87, yeah. And the thing going into 20, skew was actually very high. And in that sell-off, when the market started, obviously it news started coming out, and headlines, and market reacted quite fast to it. Put options, relatively speaking, got absolutely mullered in the move down. Vol went up. So what people saw, they saw VIX, so they saw at the money vol go up.
Mm-hmm.
But the price of the put options versus at the money actually went down quite significantly in that move, which is obviously impressive given the fact that it was the truest of a black swan. But that gets to my point. The point was put options were probably mispriced going into that event. And I think most of the times, obviously people must have been, fearful at the time and are getting long put options. That's what option tends to do. It's an emotional game, and people tend to read it really wrong and be positioned wrong when they go in for an event and they hear there's a big event coming up. There's a Fed meeting on Wednesday. We all got to buy options for that. The guy who sits with the option head out, he's going to be looking to, Monday, Tuesday, and Wednesday going into that meeting, selling those options.
And do you feel like it's the convexity of the options which allows people to be less precise, right? Like, hey, this has so much convexity, I don't really care if I'm overpaying by a little bit for those puts, right? Versus you're coming in and saying, hey, go ahead, overpay. That's what we're looking for.
Yeah, no, I think that's likely it. I mean, the convexity obviously is, I think it goes back to what I said before. I think a lot of people value options on the fact that they don't understand the underlying implied volatility. They just see the price, and they might think, okay, 10 ticks for this, it's fine. I look at it, it's like it's a sunk cost. Whereas from a vol perspective, I mean, we rarely look at, we can look at premium sometimes, but in general, we're much more, what kind of skew parameter are we getting on here? Are we getting long or short skew? what's going to be the effect if Skew moves up 1 basis points to our P&L. Obviously we will look and see, are we net long or short vol depending on where vol is. But the point is, if you're short vol through Skew, and in a very simple example, if the smile is obviously always steeper to the puts. I mean, in normal circumstance, there will be times when not, but in normal circumstance, always steeper to the puts. And one of the things that happen when the put wing is very, very steep, as the market goes down, those put options have to glide down the curve and have to go on a lower vol. So unless the at the money vol goes up more than we glide down the curve, I mean, that put option is not going to work. On its own, it might work if you would just long that put option, but you're not going to make as much of it as you think, because you're getting a kick, you're getting a drawdown from the lowering of the convexity. But obviously, the fantastic thing about options, if you buy an out of the money option when convexity and vol is cheap, and you get a big event, and not only does the volatility go up, but the convexity kicks up as well, and you get the down move. That's when you get these outsized returns in options. But most of the times when you're going into events, options starts pricing this in. The sell-off in 22 was a funny one, because during that sell-off, I remember that every single day, besides like from February and forward, they just couldn't sell enough Skew. And I think this was one of these years that for a lot of people was a bit of a conundrum, in the sense that it was the year where we a lot of times saw VIX underperform the market, and people were like, how can the market be down 2% and VIX is down? And it always comes down to a lot of people don't necessarily get
in 22, we're saying?
Sorry?
In 2022? Yeah.
So as the market went down, VIX massively underperformed. And part of that is VIX is obviously, I mean, essentially like a variance swap so it's weighted with more puts than calls, because it keeps gives your Vega exposure constant as spot moves, and Skew just got destroyed, and that's why we had so many times where market was down, VIX was down. And I remember so many people of these analysts were reading says market's not going to bottom until we see a VIX 50 event, and we never saw a VIX 50 event. So I think there's a lot of, I mean, it's a complex product for sure, and I think it's, as I said, I think the reason why, I mean, S&P is particularly driven in such a fantastic way is there's so many. I mean, even the VIX index obviously has a ton of liquidity and a lot of different players in there trying to express different views, and a lot of that feeds straight into the S&P as well, which just adds to the liquidity.
And Mike, if I'm trying to stupidly oversimplify it, can I just call you guys Skew traders?
Yeah, I mean, I would say that's pretty accurate. It's a quantitative model that basically looks at up and downside skew, right, within the calls and puts, and then there's a discretionary override to what we do. So the overlay comes, and I think this is an important distinction in terms of which volatility regime are we in, and maybe we shouldn't be looking at the last 10 years of data, because that's not really significant. The market's in a new paradigm now, and what's relevant is how it's been trading the last 6 months or a year.
And that's totally just you guys in your experience saying, hey, look, the normal models are out the window right now. This is a crazy time, or a very uncrazy time.
I mean, we can still, with our model, we can still fit the market. And one of the things, obviously, going into 2007 and 8, we did see a market back then that as market went up, Skew puts went down and calls went up. I mean, this is kind of how you intuitively would think it should work. What we really have seen, like in the last 10 years, is as the market's gone up, Skew's gone higher. And the market gone down, Skew's come down. So it's kind of gotten reversed around a bit. And obviously, I mean, anybody can kind of guess why that is. It obviously makes sense. People are buying puts when they're going up, market's going down, they're selling the puts to some extent. But I also think that the problem that happened in 7 and 8 was particularly being in Europe where market closes at 4:30. What we would see at 4:30 as the market would come down, because we were at the time long gamma, which basically meant we're going to be buying. We were buying when the market was going down. We were selling when the market was going up. And at 4:30, we had to flatten out our Skew book we had. And you would see most of the times at the second half of 08, market would literally do a mini crash at 4:30. And what a lot of people thought that was the guys hedging variance swaps, because a lot of the structured products books blew up. And that negative convexity, I think, forced like from 2009 on, where banks basically said, we can't have that risk. We can't be that short tails. So I think one of the things that's happened since then is the Skew has always been at a perpetually higher level. Because at least, we learned something from back then in a sense that, you saw how much the S&P fell, and I've always wondered, because I remember being told by a guy on the SIBO that the AOL and the Microsoft pit could be more than 50% of the underlying shares trading. That was just guys that are hedging delta. So I wonder today, when you're looking at a market today, how much out there is people buying stocks and indices, and how much of it is vol guys managing their delta and the gamma.
And expand on that a little bit. Have we seen, right, the growth of zero DTE, the growth of all these alternative income mutual funds and ETFs in the US, which are essentially option selling funds, right? Do you think that's driving more and more of this? I think some of those are covered call selling, so they're not necessarily delta hedging, but
no, I think the covered call selling, that probably doesn't matter that much. But the zero DTE and the shorter dated stuff, if you were a market maker and you're being sold options with a day or two to expiration, you can't hold that. You're going to go out of business. You're going to keep buying this. You have to sell something. But I reckon, and this is again just me guessing, when the market, it seems like every dip we've had in the market for the last long time just gets bought. And I wouldn't be surprised that's because the dealer gamma, they're the first ones to go in and hedge. And they are there as the first stuff to just buy whatever, delta they have, and they're short. And I think part of the reason, like, we're getting these moves up in some of these stocks, which has been quite impressive. Just even look at GameStop. Obviously that's a slightly different story, but, it's a big move up where, we know that retail, have been long, call options on this. And I wouldn't be surprised if retail have been leaning towards buying call options on the index as well. And that all, helps you get these squeezes, because a lot of times when the market's going up, it feels like, I don't know, I've been sitting through a lot of gamma squeezes in my life, and it does feel a bit like that. I particularly remember November last year, where we came out of October, the market was down a bit. And then in November, the first 10 days, I can't remember, it was up like 10% or something like a bat out of hell.
Yeah, I think through that end of the year, right? It was like the largest 30-day move in history, I think.
Yeah, it was crazy.
Yeah. So when these market makers, right, I'm buying my GameStop calls, I used to think, right, oh, I'm buying it from someone else who's trying to sell the calls. But I guess all Wall Street figured out, like, there's not enough money to be made if we're just waiting for someone to be on the other side of that trade. Let's create the volume. We'll sell it to you, Mr. Retail, right? We'll sell you that call. That's the market maker's job. And then they have to cover that risk.
Yeah, and that's a question whether they cover it by trying. Obviously it becomes an idiosyncratic risk, because GameStop can do what GameStop does, and they just obviously wiped out a lot of different people.
The movie's good. Did you guys watch that movie with?
I saw it, yeah.
Yeah, it was pretty good.
It was good.
Yeah.
The guy that had zero lack of risk management. That's unbelievable to get wiped out from one stock. That's
Melvin Capital.
Yeah.
But in the movie is Seth Rogen, who's like the perfect. I don't know anything about the actual guy, if that's what his personality is, but Seth Rogen just seems like an idiot managing money in that. So
Will there be a GameStop too, though, with a secondary IPO?
Right, maybe. Those producers hope so. Yeah.
I don't know what you would do if you were a market maker. I mean, if you sit, I don't know how big part of a book it will become. I mean, but you obviously selling vol at, I don't know what the vol went up to. I think it went well above 100.
Yeah.
I mean, it's almost like you sell that and try and delta hedge it as well as you can. Maybe you actually sell the vol and run slightly long delta against it. Instead of, I mean, it's hard when you're a market maker to go and buy 160 vol. I mean, you'll probably go and buy it pretty much anywhere else, even though it's obviously going to be so disconnected that you can't buy it anywhere else. But
Yeah.
it's that I'm not sure how to do that.
It's against your DNA, right?
Yeah.
We're not paying 160. So you're trading the skew, and maybe a simple example is kind of like normally 20% out of the money, the puts would be priced, say 10. I'm just throwing random numbers out there, and the calls 8. Like what's that spread look like?
We don't trade the skew like that. We actually do more like in just the puts. So, and everything we tend to do is relative value. So we don't just go and buy individual options. We'll never go and buy, say sell a call and buy a put to buy the skew.
Okay.
We'll never do that. So we do, and you let me know. And so, well, we like to do structures like, fly structures. So you basically what you do is you spend X amount of premium, and that trade is so you are not net short options, you're net flat options, but it becomes a relative value trade that sits in out of them, in these options you're interested in. So the interested options, let's say you want to sell skew, and that's the 4600 put. You think that put is too expensive, and that's about a 15 delta put option. Against that, you might be going and buying the 49 put one time. You might be selling the 46. And in order to kind of cover margin on that trade and make it, so you're not net short options, you might go and buy the 3800 put. So you essentially end up with a 1-2-1, which in option terminology is obviously called a butterfly. So that tends to be the way we'll do it. Because if we were to go do the other way, we get way too much delta risk, and we don't trade. Our fund, we don't trade futures. So basically what we do when we do a relative value trade consisting of 3 different legs of options, where we make our money is that structure, say we pay 2 ticks for that or 3 ticks for that, we can materialize that when that goes to 5 or 6, assuming we get the move in the skew correct.
Guys, you're trying to get as close to a free call option, even though it's not a call, but as close to a free trade as you can get, waiting for that dislocation to snap out.
Within kind of our trading structure, we don't take directional views on the market. We don't take directional views on volatility for the most part. It's quite low. It's purely taking advantage of, the option flows that come from these directional market structures that people trade, which is that we see within the skew.
And is that so each of those trades has a 0 delta, or there becomes a little bit of delta in there and then you have to put some
the whole by construction when we put them on tend to be 0 delta, yes. And then the money is really made that we get the convexity move right. Let's say we are long or short skew and the skew moves our way. We get that right. Then the whole change in delta of that structure changes to what we want it to be. So let's say, for instance, you have a put fly on where you're short skew. So that trade on the surface of it would be flat the market, but as the skew comes down, it gets short of the market. And if you then get a sell off, you can materialize that. So we like to write the delta exposure if it's because we got the convexity move right. Obviously, if we get it wrong, and your short skew and convexity goes up, your short skew trades become long, a lot of delta very fast. And we then either it's got to go because it's we basically cut things when the delta moves against what we had decided to move. I mean, we don't want to sit and be long a boatload of delta, even if the market is down 2%, because we're not here to bet necessarily on a recovery. I like at the end of the day to be pretty, flattish delta.
And so when you get those deltas you don't want, you're not hedging them. You're just saying we're exiting the structure we put on.
Either exiting or resetting it
Got
to
it.
log in the game.
And then that's how you're, from a portfolio level, your positive convexity performing in a crisis type period profile is getting those structures becoming short deltas and riding those in the direction you want.
Yeah, so 22 was a funny example. So 22, obviously the market was down until, it was down, can't remember, it was down 17% or something like, I can't, it was down a decent amount in
Yeah,
22.
I think 20 at one point, yeah.
Yeah. And basically I think every single day, I mean, the skew just went down. And what happened, like we would start the trade, long two puts and short, short two, but as a relative value trade. And at the end of the day, that trade just from a move in skew would be super short delta. Then the market would trade down, you'd take it off, move it further down, reset it. And then same thing would happen. And there will obviously be different kind of structures, but structures that's essentially a shorted skew without taking any delta risk.
So worst case scenario for you guys is like a sawtooth whipsaw stuff. So you're like getting too many deltas, you're exiting or resetting that, then it comes back the other way, then you're exiting, resetting that, and then back the other way.
Yeah, I mean, to be honest, the delta risk is probably less for us. I think, to be honest, one of the things that really drives our P&L is the skew. And obviously the problem that has persisted since 17 is that as the market's been going up, skew's kind of been going up, and skew was already high. And the only time where you tend to see a little bit of release or ease in skew was in sell-offs. Until like we saw here in this year, we had time. I mean, a few months ago, I think skew hit back to one of the lowest levels it was since the 2008 crisis, which is obviously interesting that it's starting to do that up here.
Theories why that is?
I mean, that's obviously where you can look maybe some of the vol selling that's coming in. I mean, what we saw in May was a bit of a surprise. I mean, I think, when Israel attacked Iran on that Friday or whether that Saturday, I mean, that Monday morning, the vol selling was just obscene. I mean, they couldn't sell vol fast enough. And the question is obviously, was it somebody that gotten long going into the event, was just getting out? But I mean, I can't remember in my career when I've seen vol being sold that aggressively in such a short period of time.
And just curiously, how do you quote unquote see that? You're just seeing the pricing come down, down, down on the options you're looking at?
Yeah,
or are you seeing like huge offers in size come in?
We see it in terms of we have a model that basically, model fits to the screen in real time. So we get live option prices into our risk management system, and we see those bids and offers on the screen. And what we basically do is we have a system with this curve, we try and match the mid value across the curve. And we do that because we have 5 parameters we move around. So skew is one of them, vol, and a few others. And what we see then, I mean, you couldn't lower vol enough. You had to keep lowering vol that day.
But it's not like you mentioned the 4,600 put before. You're not seeing like, what's the normal market? 10,000 by.
To be honest, I just look. I look at from the vol model.
Okay.
I look at everything in vol terms.
Let's talk a little bit. You've mentioned the Magnificent Seven, all this, right? What's the dispersion looking like, and how does that play into what you guys are doing, if at all, or just what are your thoughts on it? Seems like we've gone super crazy of all these single names are still moving, still having lots of volatility, and the index vol has come way down.
Yeah, I think you're right touching on that. I mean, we don't do dispersion, but I do know that, and I do think that has become a remarkably crowded trade over the last couple of years, maybe more, probably more than that. And obviously, intuitively, it has been a great trade. It's obviously, just to explain that, if people don't know that, obviously correlation is, simple example, you have an index with 2 names in it. One goes to 0, the other goes to 100. The index obviously doesn't move. And that's you being short correlation because you're short the index.
Yeah.
So obviously, as correlation goes up, which it tends to do in crises like in 7 and 8, and it tends to do it in, it even did it obviously during COVID, but the problem obviously was when you're looking at the ball there, you were looking it through the VIX. But in general, I do think that has a massive effect as well, because dispersion guys are obviously selling index vol as well. And on top of that, they're buying the individual names. And they might not be buying the old 500 individual names. So, I don't know what the Magnificent Seven now is of the S&P, if it's 20% or more than that. But I reckon you can probably buy the top 20 names in the S&P, and you probably got a good chunk of the market covered. So in essence, if Skew's coming down in the individual names, it's going to come down the index, because there's going to be ARB guys there's doing it. I mean, there are a few people out there trying to write about what will potentially happen if the dispersion trade gets unwound. Because obviously, I did see a chart a couple of weeks ago that correlation had come down to very, very low levels before the recent market turmoil. And there's obviously a natural level for correlation to kind of be at, and we're probably not at that level.
And is that a structural thing, or are they putting those trades on every day? Right? It seems like it can't get too far out of whack because it's a rather short-term trade, or no? Am I confused on that?
I don't know the maturity. I mean, when back in the days at Hall and Goldman, I mean, every single index desk what we were on, I mean, I was trading the OMX. So the OMX is the Swedish index, and against that, we were trading the OMX 30 stocks that were in there. But the reality is, you could probably only trade 5 of them. And then obviously DAX was 30 stocks. So they were all trading these individual names. So whenever you bought some individual vol, you would go and sell the index against that. That's just how you did it.
Yeah, most guys used to kind of sell dispersion, either 6 months out to a year and a half. I think people are running different types of dispersion books though, right? They're kind of legging into the single stocks and selling index against it. I mean, it seems like the overall underlying theme right now, though, is, selling volatility, right? You've obviously seen that through covered calls and the big growth of kind of like all of these vol selling strategies, as, many people have seen through the Morningstar report. And I think the same thing is taking place at a lot of the multi-strats with dispersion trading. So, when that trade comes undone, and timing is obviously unknown, can be quite ugly out there.
All right. What else are we seeing in the option space that's of note as you guys are looking at it day in, day out?
I mean, it's hard to say. I mean, I mean, it's interesting. What we are starting to see a little bit now is Skew has definitely come up a bit, and it's reacting a bit more on the downside in terms of not necessarily being sold when the market's going down. I mean, I think for me, I mean, that might not sound like a lot, but it's tidbits of a change.
Yeah.
The way I was schooled was, market puts go up when market goes down. I mean, Skew goes up. I mean, that's how it works. And since basically 11 and 12, I mean, we've kind of seen the opposite. And we're starting to see in the last like 6 to 8 months tidbits of more of a bit coming into Skew. And I don't know if that means more of a normalizing. I mean, I think the jury is still out on these 0-day options. From our understanding, at least what SIBO seems to be under the impression of as well, is the biggest vol selling is these overriders.
Yeah.
That's not going to have an effect if the market goes down. That's irrelevant. So I'm worried about that. What I'm more concerned about is who's playing around in 0-day options, because I mean I wouldn't know. I mean 0-day option for me is just a lottery ticket. I mean I would even say like a weekly option, unless particularly in an index. I mean who knows anything there? And now you're coming out supposedly with 0-day options on the VIX. So I think these things for the time being have probably had a strangely stabilizing effect on the market. I'm not sure I mean, the jury's still out because we haven't seen a big sell-off really with these things in the marketplace.
But that
And,
kind of begs the question, is it because they're in the marketplace that we haven't seen a big event?
and that could very well be. I do think a lot of the trading in the market right now is actually either it's CTAs out there doing arbitrage on futures, but I think a lot of flows come through the futures. I mean, look at the Russell 2000. What is it up like this month's 10%, something like it was up
that's
on a
crazy.
rope. Yeah. At the same time, we have one of the biggest days where NASDAQ was down 2% and that was up 5%. And obviously, that's an unwind of something that somebody had a trade on. And, there's a good news writer out there called the Daily Dirt Nap, Jared Dillon. And he's been writing about that unwind of that trade could actually be taking a lot longer than it should be taking. But I think you obviously at the same time hear people who fundamentally says, oh, okay, now it's probably time to buy Russell 2000 without kind of looking at what I'm getting at is I think a lot of the stuff out here is so technical. I mean, CTA is doing one thing, option guys doing another things, and then obviously you have all this 0-day stuff out there going on.
Do you feel like it's harder than it used to be? Right? There's more competition, there's more structures, there's more durations, there's more of everything, more competitors.
You know what, to be honest, I actually don't feel like it's harder. I mean, we trade very differently than we used to do. We used to be the type of guy, everything was done with futures. And rarely you did trades that were delta neutral. I mean, you would go and look for the strikes that you wanted and just I mean, a lot of times we would trade individuals or spreads or whatnot. And we could also trade put flies, but everything was done with futures. I actually think there's a nice simplification element of it just doing the options. I feel like there's a lot more opportunities than I've seen in a long time. A lot more.
Yeah, I just feel like you guys are masochists that's got to be the hardest game in the world, even if there's more opportunities, right? You're competing against, this is the pro level.
Yeah, no, that's true. And that's, to be honest with you, I think that as Mike kind of touched on before, I think one of our strengths is like we just focus on one index. Back in the days, I remember we were at ADG and we were trading Euro stocks against S&P. So one trade you would go and do is like, oh, now Skew is up in Europe, boom, sell Skew in Europe, buy it in S&P, hold it for 3 weeks, maybe 4 weeks, take it off, make 3 or 4 Skew points. Vol went like a vol above in Euro stocks or whatever. You buy Euro stocks vol, sell S&P vol, and you make half a vol, you do that. But I remember just in 11 and 12, like that spread just used to go like that, go out, and it's like, holy shit, when do I cut it? It's like, or when do I add to it?
Yeah.
And the divergence between names is just gone wild. And I think when you're seeing a day like we saw last week, where Nasdaq's down whatever 2% and Russell's up 5%, I mean, if you're trying to argue that in vol space, I mean, you just you throw in the towel.
Yeah, it's kind of an interesting space because obviously you've seen kind of the short sellers disappear, right? I mean, big household names that kind of have disappeared as a result of this market rally. And we've got a nice strategy because essentially in this slow upward grinding market, that's obviously not great for a vol manager because you need episodes of volatility, but we hold our own quite well. Mitigate the bleed through the relative value approach. And then when we get these periods of risk off, market volatility type events, the strategy does, quite well under those circumstances. So I don't think there's a lot of decent, I think there's a lot of market worry out there, just kind of where we are in terms of valuation levels, in terms of equity markets. I mean, people are going to kind of differ in terms of views on that, but I think in terms of having an uncorrelated strategy out there that's truly uncorrelated to beta, I think it's difficult to have products out there, and that's what I think we're doing well at.
Does the you mentioned before you saw all these tail investors jump out of their tail protection because they didn't like the bleed. Well, I kind of led the witness there, but I was going to ask, right, was that the investor's fault or the manager's fault? Right? Did those tail products have too much bleed because
I
the
I think the
manager
problem
was
was,
doing something wrong, or was the
I think
investor
tail
just
funds are just
didn't have the
constructed completely
patience?
wrong. Tail funds are just constructed completely wrong because there are definitely times where you should be long the tail, absolutely, and there are times where you shouldn't be near it.
Hmm.
You know,
well,
if you were long the tails in 22, you didn't do well. I mean, you had to be long. If you were long those tails, they had to be on ton of short delta for you to have made money.
Yeah, over
And
delta almost.
yeah, and
Yeah,
I think that's the problem. Obviously, the tail is kind of like, you know, when you go in and the market is nervous and skew is super high, it's like calling up your insurance company when your house is on fire and can I get a fire insurance? I mean, you're
yeah,
going to pay for that, and it's highly likely not going to work.
yeah. I think the 40. We'll go back to that. Whatever that the 4,600 put at the beginning of the year, right? Even though when we were down 20% in October, whatever, it was the same price that it was at the beginning of the year. So
Yeah,
20,
something like that. Yeah,
yeah, 20% down move, you had no upside in that put, which is a
no, I
disaster.
mean
Yeah,
and that's obviously where option can be a bit of a conundrum. I mean, we used to have the same going back to at Centaurus Capital. I remember we would have, you know, obviously we're an event driven, so sometimes we had some information in stocks. And I remember we had a stock that an analyst was like, these guys are going to get bought. And it was on the front of the Financial Times. Not going to mention the stock, but it
yeah,
got bought over the weekend, and we had bought call options. And we obviously made a bid in the call options, but when you went in and looked at the call options on Friday, it was like, okay, clearly we are not the only one
yeah.
who
You
think
weren't
this is
the
going to get bought.
yeah.
And I mean, I think that's what where options are pretty good because they're very emotional, and when people pile in because they believe something, they pile in, and then when it doesn't work, they pile out, and that's where we kind of sit in the middle of that.
yeah,
Yeah,
tail funds are less value driven, right? I mean, our strategy is completely value driven in terms of these out of the money options. I mean, the mandate for a tail risk manager is they need to provide that protection no matter what.
yeah,
And I think the thinking of investors is, you know, this is going to work across all market conditions. And I think what we saw in 2022 is that's not necessarily the case, right?
yeah.
Where nothing really worked. And that's the big issue I have with tail risk funds is there's just this perpetual bleed over time. And, you know, when you do get that market event, when it comes, the expectations for what these products look to deliver might not be what they thought going into it.
Yeah, and did that open up the space for relative value, say, right? Like, hey, the tail risk is also a little bit of a relative value. Like they can't always be there for every down move, right? They're just in one channel here. So, right, my as an investor, I might be like, well, relative value, I can't count on you guys in a huge down move. That would be the pan, right? And be
Yeah,
like, okay, structurally, we still put this stuff together and we think that, but I get what you're saying. But that proved kind of like, well, tail might not always be there in the down move anyway. So maybe I take a look at these relative value guys that might not be there also.
yeah, I think people kind of need to look and construct a portfolio with several of these products, right? Because the reality is no strategy is going to consistently be able to deliver with 100% certainty that objective. There's going to be things thrown into the equation which kind of could derail that. So to have different managers with different style buckets with perhaps that objective to make money on the downside, I think makes sense for an asset allocator.
Such as our
And
friends at Mutiny. Yeah.
Yeah.
exactly.
Last thoughts, Martin? Anything you want to? Oh, I wanted to bring up Hull. So when you're at Hull Trading, that's Blair Hull we're talking about?
Yes.
Yes. So we had a post. This is like 15 years ago, maybe, but there's a cool post out on our blog of a picture of his trading card during 87. And I might mess up the story, right? But I think the future, the S&P was basically limit down or whatever, wasn't trading. He was in the MMI index, I believe, which was kind of the precursor to the Dow futures. and bought like 50 contracts or something. And that just created this arb, right? Of like, hey, Chicago's moving and New York moved and came off limit. And that's what started the rally back from the 87 lows. So we'll put a link to that.
To be honest, I met him a few times. I mean, he was quite a funny man. And obviously, Hall was very much like quant driven. I mean, so for instance, if we ran a book where we had the 500 names in the S&P index, we had the index. I mean, our system, if we sold index vol, our system would say you should buy vol in this name or this name or this name. I mean, it would same thing. You sold some futures. The system will tell you which of the 500 stocks should you buy in the index. I mean, it's very quantitative. We had seasonality of vol in there. Like when can you expect this? Boring what vol moves, but like I said, kind of model just sitting in the middle saying vol's cheap now, vol's going to go up now. And actually, one of the things that blew my mind the most is like because I remember I think it was Blair Hall that came into the first when I just got hired, and he was asking us, "What do you think we lose the most money on?" We were obviously all guessing gamma, vega, beta. Yeah. It's dividends.
Which is row? No, what's the game?
That essentially becomes a row because it's obviously, that's obviously the problem. I mean, everything's priced on the forward. And the dividend gets moved from one term to the other.
And everyone's you guys are all like,
we were always on the wrong side of the dividends trade. Every time. I mean, I don't think any time in my life, I think I made money one time on dividend. That was pure luck.
Now there's dividend futures. You could delta hedge your dividends with dividend futures. Yeah.
Which obviously would be a different ball game, but that's obviously. I mean, I don't even know what the liquidity is in that, but I imagine that's got to be quite good.
Yeah, I think it's pretty good. Awesome, guys. I'll leave it there unless anyone's got some last tidbits to add, but I think we've covered a lot.
Yeah, this has been great. Thank you, Jeff.
Thank you for coming on. And we'll talk to you soon. We'll come visit you in London, Martin.
Yeah, you should.
Whereabouts are you in London?
I'm actually in, our office is down on Pall Mall, but I'm in Camden.
Okay. I'll nod my head like I know exactly where those two places are. But for those who know London, they'll know it well, right?
Exactly.
Sounds good. Appreciate your time.
All right, guys. Thanks so much. We'll talk soon.
Okay. Take care.
Bye-bye.
Okay, that's it for the pod. Thanks to Martin and Mike. Thanks to RCM for sponsoring. Thanks to Jeff Berger for producing. See you soon. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.